how did your experience as an engineer and as an analytical thinker help you? And what drove you to becoming an equity fund manager at Kothari Pioneer?
What I brought to the table was skepticism. What they brought to the table was enthusiasm.
Rising from a research analyst to being a legendary chief investment officer, he proved that great investing isn't about chasing markets, it's about questioning them. That's Sivasubramanian on MF Chronicles.
One of the biggest problems one has encountered when one talks to fund managers is when the fund size increases, it becomes difficult to manage, to maintain that same consistency.
You definitely cannot plan.
Correct.
You don't know what your portfolio is going to do next day, next quarter, next year.
Correct.
So we were lucky in a way that we are not managing money today because there is no information asymmetry. Fund manager has the same quality of information as the guy on the newbie. So both have the same information. The only difference is the judgment they make based on the information they get.
What were the learnings you were gleaning from Templeton?
After 10 years in the business, you think you've learned it all, seen it all. Then you have a global firm which takes over, and you have global fund managers with India exposures visiting you. They bring a totally different perspective. And if you think you know it all, now you understand that only a small bit of the overall picture that you know.
Welcome to MF Chronicles. Our guest today belongs to a generation that has helped shape Indian fund management long before markets became real-time and hyper-connected. Over the years, he has quietly influenced generations of investment professionals while remaining one of the industry's most thoughtful and reclusive minds. As someone who has spent decades in this industry myself, I must confess that I've also been a bit of a fanboy of his investing journey and thinking over the years. It's a real privilege to welcome the one and only Sivasubramanian.
So, engineer, handling credit, looking at promoters very closely. I would imagine that looking at credit details is a lot less savory than looking at equity details when you're talking to promoters, because you have to open up the books to get a loan, right? And then this sort of shift into a high risk asset class like equity or managing equity. Okay, how did your experience as an engineer and as an analytical thinker help you, and what drove you to becoming an equity fund manager at Kothari Pioneer?
One thing which helped was probably the fact that I became very skeptical of many of the projects which were being put up then.
Okay.
And more skeptical of companies which were putting up projects that were highly capital intensive. So as a credit analyst, the job was to look at cash flows and see as and when the projects get completed, whether they'll generate enough cash to service the loans they've taken. So the focus was on cash flows. That remained as an equity analyst as well. The focus on cash flows remained. But the shift happened in terms of thinking from looking at asset heavy businesses. As an equity analyst, we started focusing on more on asset light businesses,
Okay.
with the higher return ratios, etc.
Most of the people who today take capital for granted, in a manner of speaking, will find it very difficult to relate to what you're saying. That there was a day and age where capital was really, really scarce, and either you had to go to an institution to raise money or you had to go to the capital markets. Yeah.
Now you need just a CV.
You need just a CV,
Yeah.
and an idea and money will come to you, right?
Yeah. Yes.
Amazing how things have changed. So, there's a backstory to you joining Kothari Pioneer. I would love it if you could talk about that.
So I was, like I mentioned earlier, I was desperate to come back to Chennai. Not that Bombay was bad. Professionally, it was extremely good. But I was staying in a good place in Santa Cruz, and I had to commute every day to World Trade Center, which took me ages.
Even in those days.
Yeah, I had to either take a train or come by bus.
Okay.
Bus was a no-no, obviously. So it took me forever to reach office, and over a period of 5 years, I sort of wanted a quieter life. Though in terms of the professional exposure you get, nothing beats Bombay. And I was exploring avenues, and Kothari had already hired somebody from SBI Fund Management, P. Krishnan, and he was hired as a fund manager. So some of my CV reached him, and he, told Vivek about me. So Vivek had come to Bombay along with the Indian promoter. So Kothari Pioneer is a JV, between Pioneer of USA and the Kothari group in Chennai. So he was in Bombay to interview my boss, Ravi Mehrotra, one of the big names then, and a mentor to me, and whatever I know today is due to him. So I was probably an add-on, they'd come all the way to Chennai, and I think the office was in Dalal Street. Some office, Kothari, they had a broking arm also.
Okay.
But somewhere close to Dalal Street, the
Okay.
interview happened. And Ravi was interviewed, and then I was also interviewed. But I had to wait for, I think, 2-3 months because I didn't hear from them. Then again, I met Vivek in Chennai, and fortunately hired me at the same salary without the house. So it was actually come down, but I was happy to come back to Chennai.
Yeah, I met up with Ravi Mehrotra as well. I still remember he had this huge car. I don't know by when it was, and larger than life. I think he moved to Hong Kong, right?
Yes.
After some time. Yeah, I'd happened to meet up with him also. Why I am continuously asking these questions is because it's fascinating. They say that bankers can't become equity fund specialists, in the sense they can't manage mutual funds. Mutual fund guys cannot manage insurance money. Insurance guys should not come into banks. I mean, what they're trying to say is that people should be specialized in a vertical. And here you are, you've gone from one to the other, and you've taken it like a fish to water. So that's been very fascinating for us to see this entire thing.
Frankly, I don't know whether I was good as a banker or whether I was good as a equity analyst or fund manager. It so happened that at that point of time, the skill sets required for managing money were not in evidence in India. You had only a few public sector mutual funds, and the others were all brokers and individual investors in Bombay. So I think Vivek was probably, I think you can ask him when you talk to him, probably looking at complementary skills, skills which could be transferred from banking to maybe the mutual fund industry. It's not like it took to investing like fish to water. There's a steep learning curve. We made so many mistakes, and the management, Vivek and Ravi, were very kind, to us, and all the mistakes we made. That point of time, journalists like him were not around. They were not scrutinizing us so closely. So whatever mistakes we made were made without being scrutinized by the public at large. So that helped us, and we made all the mistakes. We probably bought all the wrong companies, but it was and fortunately our competitors made the same mistakes. Not like we were alone in making those mistakes, and on a relative basis we made fewer mistakes than them, and to that extent we did better than them.
Yeah, that's very profound if you look at it. Making lesser mistakes eventually leads to better compounding. That's pretty profound. So what was the competition like when you entered here? Who were the funds around you? Who were the stars around you? What sort of a scenario did you look at?
There was no star as such because we were all very young. I probably, Vivek, Ravi and me were probably the eldest in our office, and we were 30. Vivek probably will say he was 20, but I think we were around the same age. And our competition was even younger.
Okay.
And when we started out, we were the only fund. We were the first
Yes.
private mutual fund.
Yes.
And within 2 months, we were followed by Morgan Stanley. We launched a closed-end fund, and there was, huge queues, of investors queuing up to invest in that fund. And there was even a grey market premium because it was a closed-ended fund.
15 rupees grey market train. I remember
So
that.
the competition actually happened a year down the line, and all of us were young. And my networking skills are zilch. So I didn't know any of these guys in Bombay. And anyway, we were cut off, Chennai was seen as the backwaters. And in those days, delivery was physical.
Yes.
And many of the big brokers refused to deliver stocks in Chennai. So we didn't empanel them.
Okay.
All the foreign brokers refused. So we had to do with many of the smaller brokers in Bombay and Chennai. But they all came around in 3-4 years after we established a track record. And fortunately, NSE happened and DMAT happened. But till DMAT happened, many of the brokers had difficulty in delivering stock, because the risk of moving the script from Bombay to Chennai was a risk they wouldn't like, they were not keen on taking.
You started off by this conversation by saying that you met up with a lot of managements when you were doing the credit analysis. And when you started doing your equity research, there was probably no playbook. You're saying you made the same mistakes, your competitors probably made a little bit more mistakes than you did. So I am assuming that there was no playbook. There was no sort of guardrails, no risk management. Uh, how would you analyze a company? If you can take us through that thought process, what first principles of investing, how were you looking at companies? Today we read about it a lot as theory. It'd be nice to hear from you, from somebody who's been there, done that, in terms of how it actually got done.
Frankly, I think at that point of time, all we had was theoretical knowledge, but we sort of followed it to the T. What is lacking then compared to now is the information sources. We had to go to first principles, like you mentioned. We had to access physical balance sheets, which the balance sheets themselves were a rarity. Very tough to get some of the balance sheets. Unless you were a shareholder, you wouldn't have the balance sheets. We subscribed to a service which had clippings on companies, physical clippings.
Really?
Unfortunately, around the time we started in Chennai, a couple, the lady was ex CRISIL, very senior employee of CRISIL, had moved to Chennai with her husband, and they started this newspaper clipping service called Paradigm.
Of course.
And,
Yes, I remember Paradigm. Yeah.
So we subscribed to that, and we pushed to subscribe, by one of my colleagues, Anup Bhaskar, who later on became CIO at UTI and Bandhan.
Correct.
He literally pushed us to subscribe. We were very parsimonious as far as spending was concerned, because it was more like a startup. We were a bootstrap company, not too much cash was available. So salaries, Vivek was very fine paying salaries, but every other expense was scrutinized very closely.
Interesting. You mentioned Anup, and I'm sure that there was, you mentioned about talent at that point of time, the process. How did you hire people in your team? What were the criteria you were looking at? See, you were already in place. You knew what it took to make that leap of faith to come into equity. But then you also had to build a team. You also had to have fund managers, you had to have research analysts, which, like you mentioned, was a rarity at that point of time. What were your guiding principles when you were recruiting people under you?
Well, frankly, if I apply to my company today, I may not be hired, because the hiring criteria are very rigorous today. At that point of time, I was one of the people hired. I was not hiring. So the guys hired were, they were hired by Vivek and later on by Ravi.
Okay.
So I think you should put this question to Vivek rather than me. But the guys who were my colleagues, Anup was there. There was a guy called Akhil, who later on went to private equity, and Anil. So Sukumar joined 6 months later. We all learned from each other. Anup and Akhil had some exposure to equity, so they knew, and they were personally investing in equity. So in terms of knowledge, probably I was the worst among the the team hired then. But I think learnt, but what I brought to the table was skepticism. What they brought to the table was enthusiasm. So it was good because I could shoot down many of the ideas. Also, in the process, lost out on many of the multi-baggers going forward.
Sure. No, I think we will need to put a ticker when this episode runs out that please understand that most parts of his conversation are dry wit, okay? And he's a self-deprecating guy. Please don't take everything he takes seriously. So I'm going to run that ticker now.
Whatever I am saying is the truth. It's 100% true. So don't read anything beyond what I am saying.
That I'm going to edit out now. I want to circle back to this recruitment part and this cultural part, because I think I see that having played a lot of role in terms of when you became the CIO at Templeton. But I'll circle back to that later. I want to talk about Kothari Pioneer a bit more before I move on. Here you are managing money, bottom-up stock picking, talking about first principles, diversified equity portfolios, market cap driven, etc., etc. And suddenly, there are thematic funds which start coming. Thematic is a word which came in much later. Okay, thematic, sectoral. I think that Kothari Pioneer was a pioneer in a lot of ways, and one of the ways it was a pioneering was to launch the first Internet Opportunities Fund and the Pharma
The IT fund first.
IT fund. Okay.
Internet Opportunities Fund came later on.
Okay.
And there is a story behind that.
Yes, please.
I'll probably let.
No, we'd like to hear from you from a fund manager's perspective. What was the thought process? Because
the
your
thought
natural
process was,
skepticism.
we looked at the funds we were already managing, and we found that these stocks which were there in the three portfolios we were managing then, came from three distinct sectors.
Okay.
First was IT, and we all grew up with the IT sector. Our funds were launched in '93. Infosys had just launched their IPO. Sukumar, colleague then, was very aware of what was happening in the IT sector, and we were making a lot of bets in the IT sector. And if you look at the IT sector then and even today, the return ratio is extremely good. Capital efficiency is extremely good. And when we saw the portfolio of the three funds we're managing, three sectors stood out.
Okay.
In terms of capital intensity and the return ratios. One was IT, which was the first fund we launched. Then once we launched that, we thought we should look at other sectors as well. And two sectors which fit the bill, so to say, in terms of quality of companies and quality of the business was FMCG and pharma.
FMCG and pharma. Correct. I remember that. Yes. I forgot the third one, FMCG. Yes. Yeah. Please continue.
Yeah. So this is the story behind these funds.
But how did Sivasubramanian, the fund manager who's managing a diversified portfolio, look at three thematic concentrated funds? So what did your skepticism? How did your skepticism push back when these ideas came to you? Or was this an obvious choice? You said, I think this is a great idea, let's do it.
Definitely, not all thematic funds are great ideas, but definitely these three funds made sense that point of time, and even today, because many of these companies have stood the test of time. And you had new companies emerge in sectors like pharma from cities which were not even on the map then, like Hyderabad. So I think it was a good idea. The IT fund was mooted by the investment team.
Oh, okay.
Later on, I think the marketing and products people came up with the idea to launch FMCG and pharma.
Oh, nice. That's a great idea. Okay. Equally, when you're talking about the fact that this idea came from the investment team.
Specifically, I think it came from Sukumar.
Okay. Yeah. Sometime back when we were talking, you also said that the skepticism towards the IT sector, when there was a FOMO about IT stocks, there was a backstory you were telling me about, that you were in the US and you were listening to a presentation. Love to hear more about that.
We were also, we had a fair bit of allocation to IT, and IT was doing well. Some of these companies are marquee names today. They were very exciting companies then as well. And we had a fairly large position in the IT sector, and we had launched the IT fund as well. So we decided to attend some industry conferences globally to understand the industry better. And this was, fag end of 99, November, December 99, and Sukumar and we attended two conferences, one in London, organized by Morgan Stanley, where Mary Meeker made this eyeballs comment, about
Yes.
so that celebrated research of hers, where she gave a framework for looking at .com companies. The second was in Baltimore. We attended a tech conference by Deutsche Bank.
Okay.
So the first conference, of course, there was no standing room. Mary Meeker, we were all pushed outside the room.
Oh,
There was no standing room because she was a star then, and all these companies were going crazy. So Baltimore, normally the lunch session is the worst attended because they bring in somebody who's unrelated to give a talk. So we had a talk by an economist from, he was working in Deutsche Bank then, he had the RDNE, and he made a compelling presentation about how the whole IT sector was heating up, and the valuations just didn't make sense. Of course, Indian IT, you'll have to distinguish between Indian IT and the .com. .coms, many of the companies did not have revenues or profits.
Correct.
Indian companies were growing
Right.
extremely profitable. The only problem was they were trading at crazy multiples, and like it happened to GameStop. The moment tech started doing well, many normal companies became tech companies overnight in India also for valuation purposes. So from a valuation perspective, things started getting heating up. But these companies are still growing at upwards of 50%. So the situation is slightly different between US and India, but valuations were crazy. So we came back, we reduced our exposure, and we saw that we were lagging competitors by a huge margin. It's not 1 or 2%. Nowadays, you underperform your competitor by 1%, you get pulled up. At that point of time, we were underperforming, one of our biggest competitors by 30-40%.
Oh.
In a period of 3 months.
So I'm very tempted to ask me for 30-40% on absolute terms
Absolute.
or annualized terms?
Absolute.
Absolute term. Wow.
So, and we were kicking ourselves for exiting IT. And I don't know whether you remember, there was a famous hedge fund manager, Stanley Druckenmiller, was shorting IT. And he was so deeply in the red, he went double long on IT, the tech sector, in February of 2020. 2000, sorry, not
yes.
2020, 2000.
Yeah.
I think his analysis was right, but there was FOMO because he was getting crushed, and he went double long. And immediately after that, the market crashed.
Correct.
So probably we were saved by the market crashing because there was tremendous pressure on us, not from the management, but from the market, because we were underperforming some of our competitors by a huge margin. So we probably escaped because before we could make a mistake, the market crashed.
I think all intentions ultimately get rewarded by the universe. So the intention was right, because I think I've always believed whatever position you're working in a mutual fund, you're managing public money. So you have to be responsible for that. So if you've exited thinking the markets have overrated, your book profits have gone out, that's always a better thing than to say I lost out, and then this gentleman who went double long, it must have been a double by me, right? Or triple by me, going short and then going double long.
He was working for Soros at that point of time. He had to leave Soros.
I can imagine.
Yeah. And another celebrated fund manager, hedge fund manager, was Julian Robertson, who ran the so-called Tiger Fund. He said he couldn't understand valuation. He shut his fund because he was not into IT at all. I think his letter to investors when he shut the fund is still available on the web. You can check precisely before the crash. But he said, I don't understand this business anymore, so I'm shutting the fund. So he didn't make the mistake Stanley Druckenmiller made, but he said, let me close the shop.
Very interesting. So one of the things which actually happened in 2000, and a friend of mine has actually written a book. Praveen Palande has written a book, How Fund Managers Make You Rich. I think a substantial portion of that book also talks about the fact how investor expectations were not managed. See, the concepts like FOMO came in much later, but people like you and people in the sales and marketing teams of mutual funds had to see the NAVs go down dramatically, managing investor expectations. How did you manage investor expectations when people came up to you? You got out early, that's a good thing, but when people came and asked you about what should we do about our money, we are stuck here, we're doing that, what was your advice to them? How did you guide them? Because there was blood on the streets at that point of time.
We always were aware of the fact that mutual funds are a long-term product and meant for people who wanted to, build wealth over the longer term. But in the initial years, it was like the Wild West, and we don't know how distributors sold the funds. A lot of distributor education also, which was going on side by side. But drawdowns of the kind which happened, in 2000 is something which nobody is prepared for, including fund managers. In fact, from the time we launched a fund in 93 to a decade later, the index was at the same level.
Yeah.
So it went up, it went down, but after 10 years, we were at the same place where we started.
Correct.
So it was, I think, definitely a steep learning curve for investors and fund management companies. Fortunately, post that, we had such a strong rally, people forgot about all the,
usually short memories. Correct. Having seen the first brush with mortality, if you will, in terms of what can happen to stocks and what can happen to stock returns in India, how did that influence your risk management processes? Your guardrails to make sure that something like this probably should not have happen again. How did it influence your thinking? What was your message to your teams, upwards your shareholders? How did you manage this entire thing?
We always had a diversified portfolio. Even the peak of the IT boom, where some of the competitors had very high exposures in tech sector. We had a big exposure, but there was a huge difference between the kind of exposures we had and some of the competitors. We always built a diversified portfolio, but post the 2000 fiasco, we always, post that, we started bringing in practices like limiting exposure to a particular sector, limiting exposure to a particular stock. When I began my career, I used to have much more concentrated portfolio. And over a period of time, that changed. And of course, post the sale of Kothari Pioneer to Templeton, the risk managers also came into the picture. So guardrails were put in place so that we don't blow up. Not that we blew up. I think, like I mentioned earlier, it was all relative. And on a relative basis, we seem to have held up better than many others.
Interesting.
But the drawdown was definitely, quite gut-wrenching.
Right. Interesting. You move from Kothari Pioneer to Templeton. You move from an entrepreneurial organization to a global organization. Yeah. You move from limited information, if I can use that term, based out of Chennai. There was information limitation in any case, but in Chennai, I wouldn't assume that it was even, the noise was even lesser. To now an exposure to global streams of information. How did Sivasubramanian, the professional and the team leader, look at this entire transition? How did he manage this transition at a personal point of view and then from a professional point of view in terms of all the systems and processes that you had in place? Give us some insight.
Kothari is teamed up with Pioneer. Pioneer is the fourth oldest mutual fund in the world. Based in Boston, they're very understated. but they brought in global best practices. It's not that while Kothari Pioneer was entrepreneurial and on a good day, it was all hands on the deck. We had this. Vivek was very keen on exposing everybody to all aspects of the business.
Okay.
So I remember one day my boss was sitting at the reception when I walked into the office.
Okay.
So he was a receptionist for that day. So I don't know whether he liked it, but it happened. So the culture was completely different in the sense that there was sense of ownership, and we were expected to do whatever was required. Those days we had physical forms, and you had to go and distribute forms. So the investment team would go out, distribute forms.
Investment team would distribute forms.
There's no
Nice.
segmentation. It's not like you were treated as an investment professional or a sales professional or whatever. We shared whatever needed to be. When an IPO was launched, forms had to be printed. You go to the printer's office to collect the forms. So it was more entrepreneurial. While there were designated roles and we did our jobs, we were not limited to that. So when the transition happened, it became more formalized. And at Kothari, I knew all aspects of the business because of the exposure. Post the sale, I was in a silo in the sense I was focused only on investments. The product notes became sharper, the process notes became sharper. But in terms of global best practices, we already had them. What happened post the transition was that more foreign banks were happy to look at us because Franklin was a big name. Citi started distributing our funds. Blue Chip began the first fund to touch 100 crore, 1,000 crores.
Yeah.
So we got onto more platforms. So that was the plus. Of course, they made us wear suits, which Vivek was kind enough not to insist on. That was a huge cultural change for me. May not be for others, but for me at least. But the global best practices were there even earlier. It's not as if
No, actually, maybe I should have given you a better perspective of what I was thinking. When things that work in a joint venture, vis-a-vis in a global
both were joint ventures. This became
I mean, because I worked in an Indian a joint venture with an Indian company, wherein the Indian promoters are far more entrepreneurial. And while there are systems and processes, but you would find that the driver's seat would be occupied by the Indian promoter and the Indian entity, and decisions were faster. You could take calls, you could make mistakes. I'm not saying that there were no processes. I'm just saying that this was on steroids. When you move to a global firm, there is that much more. I'm looking for a word, but I'll settle for a word in Hindi called "therav." A calmness, serenity. Okay, let's go through the process. Let's evaluate it, which sometimes impedes speed. And it sometimes, may not be very entrepreneurial, quote unquote, in terms of its functioning. That's where I was going with when I asked you this question.
I understand the question. I think Kothari Pioneer, while it had an Indian promoter and overseas promoter, it was run professionally. The management called shots. And because we were the first of the block, we had to invent everything.
Correct.
Right from the prospectus. If you look at the first prospectus, the names of all the investment professionals will be listed there, but they will not be linked to a specific fund. Okay, that is how it was then. And it was a learning curve. I think Vivek and our company secretary practically wrote the entire prospectus. There is nothing to go by. The first open-end fund. Okay, there was nothing to go by. So we had to write it on our own. So that is how the company evolved. We launched the first open-ended fund, NAVs on a daily basis, which nobody else had attempted earlier. We did that. So again, we had to develop processes around that to launch a fund, to launch products with the daily NAVs. Then we moved to FT. When it was sold to FT, FT came with a, with a presence in India, but there was a gap in their product portfolio. They were known for value investing.
Yes.
And they had one fund, and for whatever reason, the fund, India being a growth market, the fund did not perfectly fit with the market realities then.
Yes.
And we had established a fairly decent track record, and the company was up for sale. Say they bought it, and the product gaps were plugged,
I
at least
think
in equity.
I think a lot of people would want to believe that this sort of the sort of culture you built at Kothari Pioneer along with
I
your
didn't
team.
build the culture. Built was
It's
it was
built
built by Vivek and
as the leader
Ravi.
of a firm, I would also have to take credit for everything. But the fact is that team is made of people. So people have to align themselves to that culture. What I was trying to get at is when this whole thing moved to Templeton and the funds moved to Templeton, for a longer period of time, Templeton was known by the funds which came in from Kothari. Okay, and I've been doing surveys with the Indian consumers for the longest of times, and the trust levels associated with Templeton at that point of time, and I dare say even today, were of the highest quality, actually almost at par with Indian firms. If you recollect, most global firms have not done too well in India, right? But for a firm like this to command that respect, I think it's got largely to do with people like you who've stuck your ground, stood your ground in terms of how things need to be managed, managed size, managed returns, managed investor expectations, wore suits. So I think that really counted for quite a bit.
I think it happened organically. I think I don't know whether there was a lot of thought behind all these things. The kind of people who were recruited initially and who stayed back, I think the value systems they had, and it meshed exactly with what was required at that point.
So you enter Templeton, you see a framework, you see the Indian markets, and then you also see global markets from a global investment manager's perspective. Okay, what were the learnings you were gleaning from Templeton in terms of managing your portfolios, managing your clients, managing processes? What were the learnings you had from Templeton?
The first, again, a steep learning curve.
Sure.
So after 10 years in the business, you think you've learned it all, seen it all. Then you have a global firm which takes over, and you have global fund managers with India exposures visiting you. They bring a totally different perspective. And if you think you know it all, now you understand that it's only a small bit of the overall picture that you know. So the global exposure brought insights about similar companies in different markets. You're living in a cocoon of your own. You look at relative valuations within India.
Correct.
And there are other companies, similar companies elsewhere. We have no clue about what they're trading at, and we are happy about our valuations here. So that kind of brought into perspective how globally fund managers will allocate. I'm allocating only one market. They're allocating across markets, and relative value between markets, companies which are similar in other emerging markets, what they're trading at. So the thinking definitely became sharper post takeover.
One of the biggest problems one has encountered when one talks to fund managers is that when the fund size increases, it becomes difficult to manage, to maintain that same consistency. But the funds which you managed, or you and your team have managed throughout Blue Chip, Prima, Prima Plus, for the longest period of time, I think they were consistently delivering returns and they became the benchmark, if you will, for a lot of other funds to say. How do you manage consistency like that? Now, one way is to say I made lesser mistakes, and I think that's more of a philosophical, profound thing. But to consistently do it quarter on quarter, year on year, in an era of open-end NAVs, which was already prevalent, scrutiny which has started happening from the media, lots and lots of information, and yet delivering those returns was quite the achievement.
Consistency was the end result, and I don't think you plan for, you definitely cannot plan.
Correct.
You don't know what your portfolio is going to do next day, next quarter, next year.
Correct.
And we know, the only guy who delivered consistent returns was Madoff, and we know how he did it.
Yeah.
So it's a byproduct, and it happened organically. It depends on what kind of portfolio you build, and we were lucky to be managing money at a time when the market was not that well researched. So there was still large pockets where research was not good, and we exploited that to build portfolios which delivered. So we were lucky in a way that we are not managing money today, because there is no information asymmetry. Fund manager has the same quality of information as the guy on the newbie. So both have the same information. The only difference is the judgment they make based on the information they get. At that point of time, there was still a lot of gaps. Research was limited to the top 30 companies, and the research of local brokers was not on par with the global brokers, and global brokers stuck to just stocks where they could derive some broking income. So large parts of the market were underserved, and that helped us to deliver returns in the long run.
Interesting. I'm now going to start asking you about the investing landscape. A lot of people have asked me that when I talk to you, we should talk about what sort of investments make sense at this point of time and all of that. I'm just going to broad base that a bit. I'm not going to just restrict to investments today. I'm going to go back in the past, and I'm going to ask you to relive some of the situations, because in the past as well, there were quite a few instruments you could invest in as a fund manager. There were PCDs, the coca part portion of PCDs, if you will. There were warrants, FDs at that point of time were giving very good returns. So when you were managing your portfolio, how were you looking at all of these instruments, and how did you manage to juice them out for your portfolio?
The mandate was clear. An equity fund had to invest in equities. The question of looking at debt or other instrument did not arise.
So it was part of the offer document that you could not invest in debt at all. I thought there was a portion where you could invest, right?
I don't remember exactly whether we had any leeway there.
Okay.
But we stuck to the what we stated in the prospectus. It was an equity fund. We ensured it was in equities.
Okay.
But I don't know whether we had that leeway to invest in.
No,
fixed
actually there
income.
was at that point of time in offer documents. Even income funds were allowed to invest in equity. So that is why I asked this question.
Yeah. So, but I remember we had some fixed income products as well. And I remember 99, early 2000, when, IT stocks were blowing up. There was a huge drawdown in the markets. AAA rated companies were offering NCDs at yields of 18%. I remember MRF in Chennai had a coupon of 18%. So
you are saying AAA rated companies,
yes,
were offering returns on NCDs of 18%. 18%. Wow. Amazing. Yeah.
So that was the landscape then. Of course, we've seen a gradual fall in interest rates over the last 25 years. And that probably also was a reason why equities took off. Equity valuations also got crushed post 2000 and started looking very interesting. And alternate investments like FDs and NCDs, the returns, the yields started falling gradually. So making equities much more attractive.
Interesting. So cut to today, when we are seeing a variety of styles. There's factor investing, there's quant investing, there's index investing through funds, and investing through ETFs, and there's of course conventional equity investing as well. Even in equity, there are so many slivers. In terms of market cap, in terms of themes, in terms of what have you. Looking at the investment landscape today, if you were to manage portfolios, what would be your way of looking at managing portfolios, and how would you analyze equity in the current situation?
I think the number of products we have today, there's just too many. And the whole investment landscape has got complicated too much. What we need are simple products, which are all-weather products. Many of the slivers you were talking about will work at a point in time, may not work at other points in time. What we need is a broad-based diversified portfolio, which investors could hold for the long run, and which is also the reason why I think there is a move towards uh, index funds, because you're clear about the product, you're clear that it will give market returns, and we also now know that most active fund managers struggling to beat the benchmarks. So that being the backdrop, what we require are simple products. I would like to manage a simple product, okay, and because there is a fiduciary duty to uh, deliver at least market returns, most products are now hewing closer and closer to the index. So I really don't know whether there is a need for in the mutual fund space for so many actively managed products.
It's interesting that you mentioned that, because when I look at the entire landscape, I'm seeing that there is so much of efficiency which is now starting to come in, and returns are becoming more and more predictable, like you're saying, moving towards the mean. That the inference of judgment, or the importance of judgment in terms of taking certain calls on equity, on the concentration of portfolios, has dramatically gone down. Uh, is this because of too much of efficiency, too much of scrutiny? In a manner of speaking, do you think that the art of equity investing is not differing to the science of equity investing?
The first thing I'd like to point out is the fiduciary duty you have. The second is that with so much of information, the market is becoming more and more efficient. So the ability of a fund manager to build a differentiated portfolio which will work at various points in time is going down. Okay, a judgment call may go in your favor at a point in time. Whether all your judgment calls will work going forward is something nobody knows. So it's very difficult to say whether the calls work because of skill, because of judgment, because of luck. And people who've been running portfolios for even 20, 30 years, academics are not been able to point out whether the performance is due to skill or luck. That being the case, as far as the retail investor is concerned, I think the move towards broad-based diversified portfolios and index products, I think that is the right move. Where the real skill will come will be probably in individual investors' portfolios or boutiques, where you can build concentrated portfolios, where we can really see whether your skill leads to the kind of outperformance you're talking about or not. So
Interesting.
people, even there I have issues, because people talk about those individuals who've done well. Okay, there are thousands of individuals investing in the market. All of them are good, but not all of them do better than the market.
Correct.
So probably we are looking at survivorship bias even there. So I'm looking at a lot of PMSs which say they are differentiated from mutual fund portfolios. But if you actually look at the performance, there doesn't seem to be a huge gap between a PMS. A PMS, normally the fund manager takes more concentrated calls, trades more as well, and there is no evidence that PMFs on the whole is doing better than the mutual funds on the whole. So yes, I think as quant and factor investing takes over, and with AI also probably obviating the need for fund managers, I think the mutual funds as a whole will probably gravitate towards index plus kind of investing.
And this is exactly what is happening worldwide?
It
So
has
we are-
happened already in the world. India, there were pockets of inefficiency, so we were able to beat the benchmarks till date. But I think it is going to become increasingly difficult even within India. So large caps, we are seeing that most funds are struggling to beat benchmarks. Moving down the cap curve. So mid and small caps, probably there is still inefficiency left, some research gaps which can be filled by portfolio managers. The quality of the companies in the small cap index, for example, is not that great. There are good companies, there are bad companies as well. Yeah, so you can probably pick and choose, build a portfolio there to beat the benchmark. But on the whole, it is becoming increasingly difficult to beat the benchmarks.
I'm going to push the envelope a bit more here before I get into AI and efficiency. At one point of time, the flow of money into mutual funds was not very predictable. So performance became paramount. At that point of time, judgment calls, you can call it inefficiency in the market, you can talk about fund manager capability. To generate returns, it became a very important thing, right? So we walked that extra mile, you did that extra bit of in this thing, you looked at global markets and you tried to generate that extra bit of alpha. Now the flow of money has become extremely predictable. Okay, the SIP flow is close to $2.5–3 billion a month. Okay, because of this predictable flow of money, do you think that it has somewhere tempered the risk-taking capabilities of fund managers, saying that even if I give an above average performance, I will still keep collecting money. And what is the need for me to push the envelope and get into stocks which probably are under researched, or I have to work that extra mile and get things done, because money is coming in any case and the expectations are muted in any case.
Yes, I think there is a institutional imperative to increase AUM.
Correct.
Finally, your fees is dependent on AUM.
Correct.
Not on returns. But there is a clear link between AUM and performance.
Correct.
It's the performing funds which are seeing flows.
Correct.
Okay, so we cannot diverse the performance of funds from flows. I think both are linked.
Okay.
But what is also happening is that it's not the fund managers don't want to take risk. I think they are taking risk, but every time you take a risk, there are people looking at what you are doing and whether it's adding value. Okay. So over a period of time, you'll do whatever that adds value, and that impedes risk.
Understood.
The risk-taking ability is impeded by the fact that the steps you've taken, which you think will lead to better performance, if it doesn't lead to better performance, obviously there will be a pushback. And these are all behemoths with a big risk management team and stuff like that. So there are constraints. Now you'll have to work within those constraints. You blow up, it will impact your brand. So there are constraints, and those constraints are well meant. It will ensure at least the investor gets market plus kind of returns instead of being all over the place.
Well, that's a very interesting thing, and I think this is a conversation which can actually have legs of its own. You mentioned about AUM becoming a very important thing, and I think that's fair. And one would also argue that the proliferation of new ideas and new funds is because you are trying to ring fence good performance in one fund and trying not to increase the AUM in the other. But your AUM compulsions are leading you to launch different types of funds. But like I said, that's something for another day. And I just want to now talk about the elephant in the room, AI. Okay, from 2 points of view. One is AI stocks or AI products, if you will, as an investment. How do you look at them? And simultaneously, how has, according to you, AI changed the investment process, the investment landscape for fund managers? So 2 parts. From the fund management point of view, how has AI changed things or is changing things? And from an investment analysis point of view, whether you want to pick up a stock, we keep hearing a lot of money flowing into AI stocks worldwide. A lot of private capital, a lot of public capital flowing into it. How do you justify that? What is your view on that? So these 2 questions I would love to get your view on.
AI is a very specialized topic, and I don't know whether I have the depth of knowledge to talk about AI as such. But we've seen technological changes over the last 300 years, right from the time the steam engine was invented to the railroads. We had huge investments in railroads earlier, and many of the investments were never recovered. So we've had these new breakthroughs happening, technological breakthroughs, and a lot of money going behind these breakthroughs. The internet again. So it's not as if, and many of these technological breakthroughs have become mainstream. The internet is now mainstream. Even 40 years back, very few people had computers. Now computers are getting replaced by mobile phones, which are computers in themselves.
Right.
So AI clearly is a distillation of all the knowledge which is available to mankind. Of course, I am 60 plus. A guy who's 30 and below probably will be able to explain better the impact of AI. But the kind of money which is chasing AI, and most of it is going into hardware.
Okay.
Because the computing requirements are so huge that you require tons and tons of hardware. And the kind of money which is going in, and each guy is trying to reinvent the wheel. It's not like one model is there out there.
Correct.
Okay.
Correct.
So you have 10 different wheels out there.
Correct.
Now we don't know which wheel is finally going to become the standard.
Correct.
Okay. And whether an all-compassing AI will work, or whether you need narrow AI. Like we used to talk about expert systems, the medical field. You build an expert system for just the medical field, which will do the work of doctors. Okay. Or you take another field, lawyers, expert system, legal, for just the legal system. Now it has got a fancy name, AI, and it's all encompassing. It seeks to do everything for everyone.
Correct.
And it does it reasonably well. Okay. It's a question of if it is just portfolio management within constraints, the way mutual funds are now being pushed to do, where you give index plus kind of returns, or probably an AI, you feed in the constraints, will give you similar results.
Correct.
Without high cost resources.
Correct.
Okay.
Correct. Okay.
But it's evolution, revolution. Something like AI or something like the mRNA vaccine happens, will AI catch it? I don't know.
Interesting.
Or even in research, it can do probably incremental research. You have derivative drugs, various combinations. It will take us years to do all the combinations. It will do it in a jiffy. But will it be able to think so differently to come up with something like an mRNA vaccine is something which we need to see. Plus, the investments going into AI, so humongous, whether it is going to yield the returns people are expecting is something which is a moot question.
No, it's not just the investments, mainly returns. I think we were having a discussion some time back, and one of the points in the discussion was that you have a company like OpenAI who's getting a lot of money, and by virtue of the fact that they need computing power, they're taking that capital and putting it into NVIDIA, and NVIDIA is investing back into OpenAI. So is this leading to a sort of, it reminds me a lot about what used to happen back in the day with Indian promoters when they used to have separate companies, and then, I think we discussed that also. So do you think this is a sort of a circular economy, if you will, happening on its own steam, and this is something which is not very healthy?
It looks that way to me. Money is going from one pocket to another to invest in a product, basically the NVIDIA chip, which has a life of, people say, 3 years, because a new chip will probably replace.
Correct.
And I remember, earlier we had these infra companies. When the order books fell, they created their own order book. They, floated projects of their own. Cement, if they were manufacturing cement machinery, they'll put up a cement plant themselves. When the order books went down, and book both revenue and profit on something they themselves put up. So, but at least the cement plant has a life of 30-40 years. Whereas these data centers, etc., the chips are getting obsolete within 2-3 years. So it is not I don't know whether it's capex or opex. Capex, something which will be there for some time, and you derive revenue from that over a period of time.
And the expenses get amortized.
Yes, and here you probably have to see, if you don't go for the improved chip, you're behind your competitor who will go for the newer chip. So there is a pressure on you to keep reinvesting in newer and newer chips. So I don't know, this is like a treadmill, you're going nowhere. Yes, it has got obvious benefits, nobody is denying that, but the kind of firepower, money which is being thrown at it, it's so humongous, whether we'll have a good outcome in the end from an investment standpoint is something we'll have to see.
And AI from a fund manager's perspective today in terms of his processes, do you think that that process efficiency has released a little bit of time for a fund manager to rely more on judgment and intuitive thinking, because most of the drudgery in terms of reading balance sheets, everything gets summarized?
Yeah, I think all that is being taken care of by AI. It can look at quarterly calls, it can look at investor presentations, it can analyze balance sheets. So, a lot of the drudgery of research has been taken out of your hands. So, which is definitely released more time for the real thinking. So, I think now we will see whether fund managers use that time more effectively in uncovering better ideas or not. But definitely it has improved the work of an analyst and a fund manager and release more time, more productive time for other useful purposes. Yes.
We talk about AI, you were talking about AI as well in your conversation. It's very interesting. When you were talking about the internet, you talked about eyeballs in one of the presentations which was there. Today, I think people talk about views. How many views has this particular thing got? We talked about sending stuff through the internet and became e-commerce later on. So a lot of stuff which was hyped up in internet and one thought would never see the day actually turned out to be very good 10 years down the line. When you look at AI today, what is the phase AI is in today? Is it the phase where things are hyped up, a lot of conversations are happening, or is it a phase where execution in terms of deliverables has already started happening?
I think there are a lot of parallels between the .com and the AI boom. While post 2000, the .com boom did lead to a lot of companies setting shop. We gained a lot from the .com boom. Companies like Amazon, Google, today some of the largest companies in the world. And if you look at what happened immediately post 2000, many people wrote off the .com boom. I agree that AI is being hyped up, similar to what the .com boom was being hyped up. But I think similar to what we saw post 2000, over the last 25 years, companies like Amazon or Google, there will be companies which will leverage the benefit of AI and emerge in the future. What I am worried about is the amount of investment which is going into the AI field and whether all of that will lead to positive returns. May not happen. It didn't happen in the .com era as well, but a lot of products did come out of the .com boom. A lot of companies emerged out of the .com boom. I think we will see something similar happen going forward as well. May not be the same companies. You probably will see completely different companies which will leverage the infra built by these companies to come out with something new.
Interesting. So you are saying that don't look at AI, from a point of view that this is something which is a fad, a trend. This is a structural change which is happening. The way the internet changed the world forever in 2000, that is what AI is going to do. So be patient. There will be winners, there will be losers. Is that what you're saying?
Definitely there are going to be winners.
Definitely.
Yeah, and may not be the same companies we see today.
I hope we see some of the winners in India, because that is something which is figuring in a lot of conversations, that FIs are seeking Indian companies who are good at AI or AI related work to start investing in them. I hope we start seeing some companies in India also.
We are already seeing some deep tech companies being funded in the VC space. Many of the IITs and other research outfits are shepherding these companies. But at the same time, we also see a lot of fake AI companies, where the label just changes.
Yeah.
DNA remains the same, but the label changes, and they are trying to capture the imagination of the public and the market.
Deja vu, isn't it? Internet time all over again. Companies changing their names and just.
This time is not different.
This time is not different. I'm very tempted to ask you a question. India 2026, the investment landscape which you're seeing today. I'm not talking about the capital markets. I'm talking about the evolution of the India growth story or the India capital market story, which country does it remind you of in the past? You would say that India in 2026 was like Brazil in 2000 or China in 2000. I'm just throwing some names and some dates. What I'm trying to glean is that if there are markers left by history in terms of growth of a country, in terms of its capital markets, which is the country which we are closest to? So that we can just see it going
In
forward.
terms of the institutions,
Mhm.
capital markets, etc., is way ahead of most markets in the world.
Okay.
So, for example, I remember going to China in 2005. They had a barely functioning capital market.
Okay.
Okay, met the capital market regulators there. We were far ahead of them. So, in terms of the institutions, I think we are far ahead. But your stock market's performance is linked to performance of the economy. And while we've had very good growth, China has had much better growth. True. But having said that, there is no direct link between economic growth and capital market returns. Because China, despite doing so well, last 25 years returns have been abysmal. India's returns have been far better. So, we don't know whether, my guess is the capital efficiency of Indian companies far superior to that of China, which is why we have seen
Interesting.
India, in terms of even dollar returns, India is probably second after US in terms of return last 20 years. You look at China, hardly any returns.
Correct. Correct.
Okay, even countries like Korea, Taiwan, which are favored now, where Samsung has moved up so sharply, it's become a $1 trillion company. TSMC has moved up.
Yeah.
If you look at them over 20 years, very few countries have delivered the kind of returns India has. But in terms of economy, I think we are still, a poor country, and we have a lot of catching up to do. And India is not one India. The West and South, the per capita incomes are twice the national average. East is below national average. We've seen numbers for Bengal, Bihar. Bihar is 1/3 national average. Bengal at one point of time was above national average. Their GDP was 10% of India's GDP, now down to half, 5.5. So, we have areas in India which are performing very well. The West, Gujarat, Maharashtra, South, doing very well. East is underperforming, and Central India is catching up slowly. So, it is not one India we are talking about. We have India which is growing at multiple speeds. Okay, South is a bit like Vietnam now.
Interesting.
So,
Very
South,
interesting.
we are very similar in terms of per capita.
Very interesting.
Vietnam is probably the size of one of the states in the South.
No, but I get your point. What you're saying in terms of the ethos of that region is very much very interesting.
But the thing is, India, if you look at companies, they're always careful about capital efficiency. And most Indian promoters have delivered. Which is why, our stock markets have done so well over the last 20 years. But from here on, we have to look at valuations, be realistic about the returns you can expect. So, if you've seen 13% returns compounded over last 30 years, maybe we'll do slightly lower than that. May not be 13, because the valuation, the starting point is much higher today.
Correct. Correct. So, words of wisdom for people who are listening into you. If today somebody comes up and asks you a question, where should I put in my money? Not in terms of stocks. I'm sure that you're still a little wary of talking about stocks, but in terms of asset allocation, in terms of returns expectation, global versus local, what could be your advice to somebody who wants to say that I want to invest something for the next 10 years?
You should have a diversified asset allocation. Depending on each person's risk profile, I think that will be decided asset allocation. Still positive that the Indian equities will deliver better returns than other asset classes available to Indian investors. As far as global diversification is concerned, unfortunately, you don't have a vehicle like a mutual fund which will allow you to invest in US because of the cap.
Correct.
Most funds have exhausted their limits. I'm not too keen on using other avenues to invest overseas.
Okay.
Because one, we don't know how effective, efficient they are, and there are other issues, taxation. If we get a vehicle like a mutual fund, I would suggest we look at overseas markets as well to explore. But a substantial portion of the money should be in the home market.
Okay.
Despite the currency being depreciating, etc. I think India still has probably one of the best runways of growth available to an Indian investor. Other market I would look at is definitely the US. Despite all the problems we are seeing currently, US is a highly innovating economy, and it draws brains, the best brains from across the world because of the enabling environment they have there. So, US is also an economy I'd look at. Personally, even at this stage, I'll invest at least 60% of my money in equities, maybe the balance in
16 equity, okay.
yeah, debt and other products.
And would you invest in IPOs which are coming in? A lot of IPOs.
It will depend on a case-to-case basis.
What's your view on these IPOs? Most of these guys.
Many of the IPOs either high priced or probably should not have hit the markets right now.
Okay. Interesting. This was a fascinating conversation. I think we started by talking about you as a person, then we moved to you as a professional, and then how both have evolved over a period of time. I think I've personally learned quite a bit on this. And one of the things I'd like to just share with viewers is that even while he was talking and I was listening in, I felt like I was watching a Christopher Nolan movie. If any of you watched a Christopher Nolan movie, a movie like Inception, for example, you might think that some things don't make sense initially. So you have to watch the movie a second time and a third time till the time it starts really hitting you as to the depth of what that movie was projecting. Whatever Shiva was talking about right now looks very simple, calibrated, moderated. But if you go back and listen to this conversation again and again, you will realize that there are so many nuggets of wisdom that have come through, so many Easter eggs, as one would like to say, that it will help you clarify. It will give you a lot of clarity in your mind in terms of how to look at investments. Most people look at investments, there's a FOMO effect at times, and there's a short-term thinking at times, and there's an over concentration at times. But I think he's in his own inimitable way touched upon all of these points and how he's dealt with that. I've had a wonderful time talking to you, sir. This has been an amazing conversation. Thank you for being on MF Chronicles.
Thank you, Vikaas.